We continue to note resilience in the residential property market. Looking at the April 2026 data, our house price index increased by 5.4% year on year, which is only slightly down from 5.7% in March. But when you look at the first 4 months of the year, you will see an average of 5.7%, which has outpaced our expected inflation over the same period of 3.4%. So there's real house price appreciation, and this market performance is really just showing you tailwinds of not only constrained supply but demand that has started to pick up, led by your higher value segments, right? And so we thought, as long as financial conditions remain supportive, you would see that demand broadening, and with mortgage volumes improving, it would result or usher in a new wave of house price appreciation going into 2027-2028. Now, obviously, the war has started to tighten financial conditions and threaten some of those support factors that would continue to support the cyclical recovery in the property market. So that's the unfortunate part, especially when you think about the weight that could be felt in the lower value segments. That said, we still think there are a few long-term anchors that could support more robust and durable market outcomes in the longer run. And these range from supply support factors, especially with the reform agenda. Improved service delivery will also support construction. We also see on the demand side that reform agenda supporting confidence, more participation and investment in the longer term towards South Africa. You can also imagine that an improved operating environment will support employment, affordability, financial conditions. So that could also reinforce this idea that you have the supply and demand, improvement over the long run that could underpin this market. It's just unfortunate that for the next year or two, we'll probably experience volatility and potentially much slower growth than what we anticipated, depending on how inflation evolves as well as financial conditions.